Hold on tight because we're in for a wild ride in the stock market. The financial world has been nothing short of a roller coaster lately, with ups and downs that have left even the most seasoned investors feeling queasy. The catalyst for this wild ride? None other than President Trump's tariff threats. Trump's tariff threats sent shockwaves through Wall Street, causing a dip that had investors hitting the panic button. The uncertainty surrounding international trade policies created a ripple effect, leading to a significant sell-off in the market. Traders were on edge, and the atmosphere was thick with anxiety. The S&P 500 took a tumble, leaving many wondering if this was the start of a bear market. The sudden drop in stock prices was alarming, and financial analysts were quick to speculate on the long-term implications. Was this a temporary setback, or were we on the brink of a more severe economic downturn? But fear not, because I saw this as a golden opportunity, a chance to buy low and watch my investments soar. While others were selling in a frenzy, I remained calm and collected. I knew that market dips are often followed by rebounds, and this was my moment to capitalize on the situation. You see, I'm a firm believer in the old adage, buy low, sell high. This principle has guided my investment strategy for years, and it has never let me down. When the market is in turmoil, that's when the real opportunities arise, and when the market dips, it's like a giant clearance sale on Wall Street. Stocks that were once overvalued become affordable, and the potential for future gains becomes even more enticing. It's all about having the right mindset and staying focused on the bigger picture. Stocks become undervalued, presenting a chance to snag them at a bargain price. This is the time to do your research, identify the hidden gems, and make strategic investments that will pay off in the long run. Of course, timing is everything, and knowing when to buy the dip is crucial. It's not just about jumping in at the first sign of a drop, it's about understanding the market trends and making informed decisions. Patience and diligence are key. This recent dip, triggered by Trump's tariff threats, felt different. The market's reaction seemed exaggerated, driven more by fear and uncertainty than by actual economic fundamentals. It was a classic case of market psychology at play. It felt like an overreaction, a knee-jerk response to uncertainty. Investors were quick to sell off their holdings, not wanting to be caught in a potential downturn, but for those who could see beyond the immediate panic, there was a clear opportunity, and that's when I knew it was time to strike. With a clear strategy in mind and a focus on long-term gains, I made my move. The market may be unpredictable, but with the right approach, you can turn volatility into victory. Trump's tariff threats against Mexico and Canada sent shockwaves through the global economy. Investors were left reeling as markets reacted to the uncertainty, with stock prices plummeting and financial analysts scrambling to make sense of the new landscape. He slapped a hefty 25% tariff on imports from our North American neighbors, a move that was both bold and controversial. This decision set off a trade war that threatened to upend decades of economic cooperation. Business leaders and policymakers were suddenly thrust into a whirlwind of negotiations and strategy sessions, trying to mitigate the fallout. The move sent businesses scrambling to adjust their supply chains. Companies had to rethink their logistics, sourcing, and production strategies almost overnight. Consumers were left bracing for higher prices on everything from cars to avocados. The ripple effects of the tariffs were felt in everyday life, as the cost of goods began to rise. The tariffs were a major escalation in Trump's protectionist trade policies, which had already sparked tensions with China and other major trading partners. His approach was seen as a significant departure from the free trade principles that had guided U.S. policy for decades. These policies had already led to strained relations with China and other key economic players. The global trade environment was becoming increasingly volatile. He argued that the tariffs were necessary to protect American jobs and reduce the trade deficit. Trump believed that by imposing these tariffs, he could revitalize American manufacturing and create a more balanced trade environment, but critics warned that they would backfire, potentially causing more harm than good. They argued that the tariffs could lead to job losses and higher costs for American businesses and consumers. The concern was that these measures would hurt American businesses and consumers while doing little to address the underlying economic issues. The debate over the effectiveness of the tariffs was intense and ongoing. The tariffs were met with swift retaliation from Mexico and Canada, who imposed their own tariffs on a range of American goods. This tit-for-tat escalation only added fuel to the fire. These retaliatory measures targeted key American exports. further complicating the trade landscape. The impact was felt across various sectors, from agriculture to manufacturing. The trade war threatened to disrupt the highly integrated North American economy, which relies heavily on cross-border trade. The interconnected nature of the economies meant that the repercussions were widespread. The future of North American trade hung in the balance as businesses and governments grappled with the new reality. The stakes were high and the path forward was uncertain. The potential economic fallout from a full-blown trade war with Mexico and Canada was significant. Economists warned that the tariffs could lead to job losses, higher prices for consumers, and slower economic growth. The tariffs would disrupt supply chains, forcing businesses to find new suppliers or pay more for imported goods. The tariffs would also likely lead to higher prices for consumers, as businesses passed on the increased costs of imported goods. This could lead to inflation, eroding the purchasing power of consumers and further slowing economic growth. The uncertainty created by the trade war could also make businesses hesitant to invest and hire, further dampening economic activity. In short, the tariffs were a recipe for economic disaster. They would hurt American businesses and consumers, damage our relationships with our closest trading partners, and do little to address the underlying economic issues that Trump claimed to be addressing. While the tariff threats sent shockwaves through the market, the reactions were swift and intense. Investors scrambled to adjust their portfolios, and traders were on edge, anticipating the next move. I couldn't shake the feeling that this was all part of Trump's negotiating playbook. His strategy was clear to those who had been paying attention. He'd used this tactic before, threatening tariffs and other punitive measures to extract concessions from trading partners. It was a high-stakes game of brinkmanship, and more often than not, it seemed to work. The markets would eventually stabilize and deals would be struck, often in America's favor. Trump's approach to trade was unorthodox, to say the least. He eschewed traditional diplomacy, preferring a more direct and often confrontational style, preferring to negotiate in public and through Twitter. His tweets could move markets and influence international relations in real time. He wasn't afraid to use threats and bluster to get his way. His boldness was both his strength and his weakness. And while his tactics often drew criticism from economists and foreign policy experts who warned of long-term consequences, they also seemed to keep his opponents off balance. Foreign leaders and political opponents were often left scrambling to respond. In the case of the tariffs on Mexico and Canada, the stakes were particularly high. These were two of America's largest trading partners. I suspected that Trump was using them as leverage to renegotiate the North American Free Trade Agreement, or NAFTA. This was a cornerstone of his trade policy. He'd long criticized NAFTA as a bad deal for America, claiming it had cost American jobs and hurt the economy, and he'd made renegotiating it a key campaign promise. His supporters believed in his vision of a better deal for America, and he was determined to deliver. Section 5. Seizing the opportunity. Why I bought the dip. So, while others panicked, I saw an opportunity. I knew that Trump, for all his bluster, ultimately wanted a strong stock market. It was one of his favorite barometers of success, and he wouldn't want to see it tank on his watch. This gave me confidence that the tariffs were a negotiating tactic, not a long-term strategy. I decided to buy the dip, scooping up shares of the S&P 500 through a low-cost ETF. This allowed me to diversify my holdings across a broad range of companies, reducing my risk if the market continued to decline. But more importantly, it positioned me to capitalize on the rebound I was confident would come. Section 6. History repeats itself. The Fed pivot and market rebound. My confidence in buying the dip wasn't just based on gut feeling, it was rooted in historical data. Time and time again, the stock market has rebounded after periods of decline, and one of the most reliable indicators of a market turnaround is a pivot by the Federal Reserve. The Fed had already pivoted once before, back in September 2024. After months of raising interest rates, the Fed signaled that it would be pausing its rate hikes, citing concerns about slowing economic growth. This pivot led to a surge in the stock market, with the S&P 500 rallying sharply from its lows. I believed that the Fed would pivot again if the trade war with Mexico and Canada escalated and threatened to derail the economy. And when the Fed pivots, the market tends to follow. Section 7. Diversification. Don't put all your eggs in one basket. While I'm bullish on the long-term prospects of the stock market, I'm also a firm believer in diversification. That's why I don't put all my eggs in one basket. In addition to stocks, I also own physical gold and silver. Gold and silver are often seen as safe haven assets, which means that they tend to hold their value or even increase in value during times of economic uncertainty. They can act as a hedge against inflation and a weakening dollar. While they may not offer the same growth potential as stocks, they provide a valuable layer of protection for my portfolio. As Section 8, Trump's market influence, a game of speculation. Trump's relationship with the stock market is complex. He clearly views the market as a barometer of his success, and he often boasts about its performance under his presidency, but he's also been accused of manipulating the market for his own benefit. Some have speculated that Trump's tariff threats are part of a deliberate strategy to crash the market so that he and his wealthy allies can buy up assets at bargain prices. This theory, often referred to as disaster capitalism, suggests that Trump is willing to inflict short-term pain on the economy if it means long-term gains for himself and his inner circle. While it's impossible to know for sure what motivates Trump's actions, it's clear that he understands the power of the market and his ability to influence it. Section 9. The long game, staying invested for the long haul. Despite the recent volatility and uncertainty, I remain optimistic about the long-term prospects of the stock market. Over the long run, the market has always trended upwards, and while there will always be dips and corrections along the way, those who stay invested are rewarded. My advice to investors is simple: don't panic, stay the course. Continue to invest regularly in a diversified portfolio of stocks, bonds, and other assets, and when the market dips, don't be afraid to buy. Remember, the best time to buy is when everyone else is selling. Please remember, it is not a financial advice.